This is Trepp Wire Week in Review for week ending September 25th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. Joining me are Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance, and Lonnie Hendry, Head of our Advisory Services. This week, the uneven recovery continues, but with renewed concerns over a number of issues. A lack of congressional stimulus for targeted industries, a second wave of the virus, which we're seeing in Europe, and reignited social unrest in a number of cities. At a House Finance Committee hearing this week, Treasury Secretary Mnuchin and Fed Chair Powell were pressed again about relief for CRE borrowers in the wake of more layoffs and delinquencies. They acknowledged that the CRE market has an issue, but there isn't a, quote, good solution. Manus, both Powell and Mnuchin are looking to Congress to make the move here. And as of today, House Democrats are pushing a relief bill. The question is, will that include CRE?
Well, it's certainly been an interesting week, hasn't it? It started about 24 hours after we did our last podcast with the surprise news that Supreme Court Justice Ruth Bader Ginsburg had passed away. We wrote to our clients Monday morning. It was our first note about it, in addition to, obviously, the human impact for her family and her fans and so forth, the notorious RBG. We did say that it made it very unlikely that Congress would pass a stimulus bill. It was probably already DOA, right? There was no unanimity between the White House, the Senate, and the House. The House wasn't able to really put together something that was palatable for those in the Senate and vice versa. So it was already on fumes to begin with, but it seemed like everybody pivoted at that moment to their talking points and their preparedness for the SCOTUS debate. So that's probably even more DOA now than it was, despite the news today that Nancy Pelosi was putting out a $2.4 billion stimulus proposal. As far as Powell and Mnuchin's conversations this week, there's a lot in there. I'll give an early shout out to RD, who was giving me the play-by-play as he was watching it. I ended up watching it about 4 hours later. It was about 2 hours worth of good and bad. On the good side, both of them acknowledged that the U.S. economy is really rebounding nicely from the depths of the COVID, although some House members took exception with that perspective, but they were pretty bullish on where we've been and where we're going. But on the very specific part of CRE and CMBS, they were emphatic that there's really nothing they can do. If you're interested, we'll send you the YouTube link and we'll tell you exactly where you can pick up their testimony. There's a little bit in hour 1 and a little bit in hour 2 where they say because of the structural limitations in CMBS and because it's impossible for them to put cash in the hands of property owners, there's really not much they can do, which for those that have listened to our podcast for several weeks, we've acknowledged that. It's no surprise to us. And it's the reason that Van Taylor and the HOPE Act pushed out a proposal that used preferred equity as the vehicle to help. But right now, I think even that is on fumes, largely because while there's big endorsers of that proposal at the property owner side and on parts of Congress, there's also those on the other side which feel it's a bailout for the wealthy, in addition to some that feel like the benefit will go to the hotel owners and not the rank and file workers that staff these hotels. So I'm not optimistic on either.
I think the AHLA came out this week with a survey. That's the, what is it, American Hotel Labor Association. And they said that, Lodging Association. And they said that 74% of hotels will have to lay off more employees unless there's some aid from Congress. So I do think that if you're a hotel owner and you get some aid, the first thing you're probably doing is paying your mortgage because you don't want to lose the property. But after that, I have to think that the majority of people are good people and that they would, try to keep as much staff on as they possibly could. I think they could potentially structure something like PPP, right? Where if it was aid, it would have to, some percentage of it would have to go to payroll, right? I think that would be a way to get around the kind of bad optics of bailing out borrowers and owners. But, I would just say again, there is a long tail. There are thousands and thousands of mom and pop investors who own, a couple of multifamilies, or maybe they own, 2 hotels or whatever it may be. And they're hurting, just as much as the big boys. So I don't know really if I want to lobby for a bailout or not, but I think the argument that you're only going to be helping the rich is semi misguided, maybe.
It's a tough call, but I think that at this point, with Congress focused so heavily on the election and the immediate Supreme Court vacancy, I think it's unlikely, as we said before, and I do believe that the things that they did offer in their conversations was for these smaller mom and pops to use the PPP wherever they could in lieu of some other bailout form. And they talked about lowering the threshold of who could tap this from where it is now to something much lower. But the real headline is the cavalry is not coming for CRE in the near future.
Staying on regulatory issues, Lonnie, California Prop 15 is on the ballot for November 3rd and has some direct implications for CRE.
Yeah, so California is very unique. It passed Proposition 13, I believe, in like 1979, which effectively limited annual reassessments on the commercial property sector, as well as residential, to whenever the property transferred. So it no longer was on a set schedule. It was only when properties were actually sold. And Prop 15, also known as the Split Roll Initiative, essentially says that for commercial properties, which does not include multifamily, but for commercial properties, income producing, that those properties would essentially be reassessed on an annual basis at market value. So this has some pretty wide-standing, as Joe says, a long tail. I mean, if you start taking things from, a value that was maybe set in 1980 or the 1990s and bringing it current to today's market value, there's going to be some pretty hefty increases. And on a lot of commercial properties, specifically office and retail, the way those leases are structured, a lot of those CAM charges, taxes, insurance, maintenance, et cetera, get passed through to the tenant. So, the proponents for this say that it will bring more equity to the markets because the commercial property owners are paying a lesser share of the tax burden at this point because those properties don't transfer as often as the single family residential. But on the flip side, you have a lot of folks that are in the CRE space that effectively say this would kill any type of investment activity in California because the mom and pop business owners are going to be put out of business effectively as soon as they start paying those taxes. And then investors are going to find other markets where it's more tax friendly.
But you gotta think. I think Fritz Kagi, right, from Cook County. We had him on a while ago, and he was talking a lot about this, and he told us the story of, the Golden Girls house or something in Brentwood that was paying like $3,000 in taxes because it hadn't been sold in like 40 years. So I think there's something to be said for properly assessing properties and getting the proper amount of taxes from them. And it's not really fair if I own a building across the street from a building that's very, very similar, and that guy, just because he's been there for 30 years, is paying like 10x less in taxes. But it doesn't make so much sense to me that they're only doing it on commercial. Wouldn't it make sense to do it like across the board, and then it was just kind of equal playing field for everybody?
I think it's interesting because property taxes become political very quickly, right? So your voter base is generally made up of single family or smaller homeowner, type of investors. And so, you want to stay strong with your voting base while trying to generate revenue for schools and other things that, help the public. And so, I think, as you've stated, Joe, anytime you have things partitioned based on date of acquisition, I mean, that to me screams inequity. And so I don't think that the current system works, and I don't know necessarily if I think this solves the problem either.
As somebody that lived in the suburbs for several decades, I think there's three things that are, at the top of the list for what will trigger neighbor versus neighbor. One is the use of a leaf blower. The second is a political sign, especially right now. And the third is knowing that your neighbor pays 1/3 as much property taxes as you do. I lived through that in a neighborhood years ago where they tried to set the scale or reset the scale. And there were some people for which their property taxes went down 30 or 40%, and there was others for whom it went up 30 or 40%. And if you think Trump versus Biden signs is a bad thing, you should have seen that.
It's like you never talk about your salary, right? It's just on salary, property taxes, and death, basically. You don't talk about it.
And in California,
politics,
if you use a gas leaf blower, then it's over because they only want electric leaf blowers out there. So
that's right. Then you're double dead.
In Westchester, New York, it's a leaf blower of any kind. All you're doing is kind of pushing around the dust and the leaves, and you're taking your leaves and you're putting them on your neighbor's lawn ultimately once the wind comes in. So that's something people will go to the mat for.
Passive aggressive behavior. Listeners who listened a couple of weeks ago heard us talk about the CDC implementing an eviction moratorium, and we scratched our heads a little bit on that one. Lonnie, it looks like someone has sued the CDC about that.
Yeah, so I think Joe McBride probably gets some credit on this one. I think he was the one questioning it on the podcast on what legal authority does the CDC have to implement housing regulation or eviction moratoriums. And so the New Civil Liberties Alliance actually filed a lawsuit, and the National Apartment Association has joined that lawsuit, essentially alleging or requesting a temporary restraining order or a preliminary injunction to stop the action. And basically have said that the CDC has encroached on private property rights, and they have no legal or statutory authority to supersede local or state law, which is effectively what they're trying to do. And then obviously they've attached, a litany of items in terms of not being able to collect rent. Now they have a lot of past due rent that probably will never be collectible, and some of the damages that just won't be recovered for them if this is implemented.
I was disappointed that Joe took that step and tipped these people off to going after the CDC. I had written a letter asking them to take on next people that don't walk in a straight line on a city street and those that fail to respect the quiet car rules on Metro North. I thought if they could take on, rent and forgiveness and so forth, that, it's wide open. There's nothing that they can't take on.
I would say the office nail clipper and the woman who eats a hard-boiled egg on the morning train in to the city every morning.
Yeah, we're gonna have to.
That's definitely against CDC guidelines.
Yeah, the cell phone watcher as they're walking across the crosswalk and not paying attention to the cars coming. That's one that'd be on my list.
We're gonna have to come up with a top 10.
This might be something people have forgotten because there is no more live sports anymore, but the guy that won't wait for the whistle at the hockey game to take his seat, that's another one.
Wait for the whistle. Anybody who's been to a Rangers game in the last 30 years in the blue seats knows what we're talking about.
Absolutely.
That's actually a good call to action. I think you got to email podcast@trepp.com and let us know what you think the CDC should take on next.
Nice. So CRE loans in bank portfolios are showing stress, and we talked a little bit about a report we put out last week. That's the taller report that was specifically looking at bank portfolio performance. But how does that performance compare to CMBS, Manus?
Well, it's interesting. I'll do a second early shout out. We're really breaking our script this week. A shout out to Matt Kelly of Stevens Inc. We were honored to be part of their 10th annual banking conference this week. Lonnie and I went on and joined them for an hour of conversation talking about the differences between CMBS and CRE, the state of the lending space in both, going through property types, going through the differences between CMBS and CRE. The Stevens guys, they're out of Little Rock, and they have a terrific research team. They came to us through the podcast, which was terrific. They cover commercial real estate exposure at the community banks that they cover, which is one of their big footprints. But one of the topics we talked about was the difference between bank loans and CMBS loans. And we put together kind of a litany of things, and I'll run through them very quickly. This is kind of a parenthetical educational part. One thing we talked about was leverage. Most people know this, but maybe not everybody. Bank loans tend to be less levered than our CMBS loans. We went through the last 3 years of history in our taller database, which is self-reported C&I and CRE loans from top US banks, which showed that by and large, CMBS to a senior loan has about 5 to 7% more leverage than the average bank loan. So lodging, the average LTV over the last 3 years for bank loans, 57, in CMBS space, 62, industrial 55 versus 63, retail 55 versus 64. Multifamily had the biggest difference, 56 on the bank side, 65 on CMBS. I should say the CMBS side does not include GSE. It's just private label. Office was surprisingly close, 60 for the banks, 61 for the conduits. We should point out, though, that the conduit numbers don't include mezz loans. So if you were to tack that on to the CMBS numbers, you'd probably see those numbers we reported for CMBS, inch up another 2, 3, 4% on average. So that gives you a sense of that. On the delinquency side, we've talked a long time about how CMBS is just exploding right now, 9% at last look overall. On the bank side, we're still under 100 basis points, even though it's rising, not nearly at the pace that we've seen on CMBS. Part of that is probably because CMBS is more rigid in the rules and what they can do in terms of offering relief versus bank lending. One of the big differences between the two that we talked about during the Stevens conference. Average loan size, CMBS closer to 15 to 25 million per loan, depending on the year that you looked. In our taller data, the median loan size, 3 million for the banks, the average size, 7 million. And lastly, CMBS loans are non-recourse, meaning the borrower can just throw back the keys without any other ramifications. Bank loans tend to be recourse loans, and that's another big differentiator. So we talked about that a lot at the Stevens conference. And if you have any questions on this topic, shoot us an email, and we're happy to give you some backup data we collected.
Yeah, it's funny, we had two conferences on the same day. I was speaking at one of our partner companies, Abrigo. They're a company that offers banking software, loan origination systems, other things like that. And we partner with them in a few areas, and they had their client conference. And actually, I logged in early because I had to speak at this panel, and the panel before me was a bunch of smaller community bankers talking about their PPP process and how much in the way of origination they did. And there were a bank or two in there who, is $1 billion bank who did $350 million in PPP loans. So it was a huge, huge program for the community bank world. And, anecdotally, again, one of the bankers was talking about how he had, he's been in the business for 20 years and he's never gotten so many messages and letters from people thanking him and saying, this loan got me through the quarantine. This loan helped me keep my doors open, things like that. So it was really cool to hear all that. But I also was talking about some of this data, and the other part about CMBS versus banks is the banks are normally shorter term and floating rate. A lot of times it's like a 3 or a 5 year loan with, and then at the end of that 3 or 5 years, it's more of a renewal. It's technically a refinance, but it's much easier for, a bank to just come in, have a conversation with their client, re-underwrite and write the new loan, as opposed to, going through the CMBS process. We also talked about, going back to months ago when we were talking about the grace period, right? And seeing that early warning sign going on. And I always try to say that, while there are differences on the finance side, the properties themselves oftentimes are not overwhelmingly different. Like there are a lot of huge malls that are in CMBS and a lot of kind of asset types that may not go on insurance company and bank balance sheets. But, the middle of the bell curve is, a multifamily in a secondary or tertiary market, which is just the same as what a community bank would be lending at. So very interesting to hear from that kind of segment of the market. And I got to give a shout out to my boy Nolan at Abrigo. I know we're breaking the rules by doing our shout outs early, but got to throw it in there.
Yes, it was conference week. Not only do we have conferences, we had other engagements as well. I don't know about you, Joe, but it meant a couple of things which I hadn't done since March.
Shower?
I shaved twice, 2 consecutive days.
Woo!
First time since March. Even shelled out for a new razor.
Your face must be on fire.
It's, it was something different. I went to Kohl's to get a blazer because I realized now that I'm down in South Carolina for most of my time that I was blazerless.
Was it open?
South Carolina. It was open. It was doing good business. My wife reprised that line from the old Saturday Night Live about Joseph A. Bank. Oh my God, it's cheaper than paper towel. Right? The clothing was so cheap that, we walked out there with a bundle of stuff, including, in my case, 2 blazers, which she was nice enough last night to point out that the weatherman was wearing the exact same blazer that I was wearing. So,
and not Lee Goldberg, like the local weatherman, right?
Yeah. Oh yeah. Not,
not Joe Rayo.
Not Joe Rayo, or who's the guy who's on the Today Show? Al Roker. No Al Roker.
No Mr. G.
No Mr. G.
Now looking at CMBS and CRE in some more detail, let's look at some of the headlines we tracked this week, Manus.
It's there's a lot of stuff out there, and it's not particularly encouraging unless you have a lot of dry powder and you're looking for distressed assets. A lot of stories of borrowers ready to throw in the towel, value reduction, really touching upon things across the 4 corners of the U.S. I'll run through some of the headlines. The Park Plaza Mall in Little Rock, Arkansas, it backs a $76 million CMBS loan. The property was valued at $142 million in 2011, cut to just $33 million this month.
That's like reminiscent of 2010, 2011 reappraisals.
It brings up a thought that I was going to throw out there, which is, there's not a lot of transactions that you can see right now on distressed assets. We're still seeing a lot of lending and property sales in multifamily, industrial, and some office, and maybe some grocery anchored retail or Target/Walmart anchored retail, but nothing in hotel to speak of, except one notable exception we'll talk about later, and none in the shopping mall space. So we're putting out a piece next week that in the land of the blind distressed property sales bidder, right, where you don't know where values are right now, the analyst looking at new valuations is king. And
right.
We've gotten so many new valuations right now that if nothing else, that gives you an indication of where somebody like a Cushman & Wakefield or a JLL working as an independent third-party valuer sees these things. So that's just our tip of the week for those that are trying to get their arms around what valuation might be. But as for other headlines, the Florence Mall in Florence, Kentucky, it backs a $90 million CMBX 6 loan. The property is valued at $158 million. The borrower wants to transition the property back to the lender. So what does that tell you? It says the property is worth less than $90 million today, down from 158 back in 2012. In the same CMBX 6 deal, the Fashion Square Mall, $33 million in debt on it. The borrower also wants to go deed in lieu there, DIL. The Round Rock Crossing, a $30 million loan. Round Rock, Texas, was valued at $45 million in 2014. The borrower wants to hand back the keys. The Kipsap Mall, $76 million loan, valued at $111 million in 2013. Silverdale, Washington is the location of that property. Borrower wants to mail in the keys. On the hotel side, the Hilton Garden Inn near the Houston Bush Airport, valued at $25 million in 2016, half that value now. Embassy Suites Lubbock appears to be headed for deed in lieu. Holiday Inn Express in Novi, Michigan, a $9.8 million loan going back to the lender. Candlewood Suites in Syracuse, $6.7 million loan, same thing. And the Trumbull Marriott, deed in lieu, $20.9 million. These things can be fluid. Sometimes there's a change of heart by the borrowers. Things don't always go deed in lieu. But while I just rattled off 10 names right there, I probably could have rattled off 30, 40, 50. So for those licking their chops, your day is coming probably in Q4. For everybody else, it's buckle up and wait.
Speaking of licking your chops, I saw Blackstone had finished raising an $8 billion property debt fund this week. And you're seeing stories like that left and right. So there is just, and this is such a cliche. Again, one of my themes in my talk yesterday was all the COVID cliches, right? Hub and spoke, unprecedented, right? Plexiglass, blah, blah, blah. But they're cliches because they're true. And there's so much capital on the sidelines kind of just waiting to pounce at this point. So, and I think they've been delayed by all these forbearances and this kind of pause that's happened. And I think Q4 is going to be when the levee starts to break.
Yeah, I would agree with you, Joe. So in my role at Trepp, I spend a lot of time with clients and prospects. And so just to echo the sentiment from the Blackstone capital raise, I mean, there's a lot of distressed debt funds that have been created where there's a lot of dry powder. I think what will be very interesting on the CRE front is when these properties start getting traded at such a low value, are you getting close enough just to the intrinsic land value on those assets that some of them get scraped and you see a complete new development? So especially for a lot of these mall properties, I think what you're going to see if you go back to the mid 80s with the savings and loans crisis and the RTC that was created, you may see some of these mall properties that get purchased at pennies on the dollar completely scraped, and then you get a much more urban density filled, mixed use office, retail, multifamily type of structure in its place. So long term, we can maybe get rid of the retail apocalypse and actually start talking about what this new generation of those spaces and sites might look like.
Maybe you can give us your thoughts on that, Lonnie, a little bit deeper. My feeling is that retail will be the first to clear because its problems have been so long standing and there seems like no turning it around. Whereas for hotels, we really don't know what the future holds. Some of these things had 80% average annual occupancy. We're running at maybe a 225x debt service coverage ratio. So we don't really know where they're coming back to. So finding the bottom may take a lot longer.
Yeah, I agree. And I think one of the benefits of the hotel industry from a rebound perspective is they're in a night-to-night business. So there's a lot of pent-up demand from people being trapped in their homes that as soon as it's safe to get out, those businesses could recover, almost immediately. Whereas the retail space, longer-term leases, more archaic structure, those folks just aren't coming back. And so I think that's a very valid point.
So Lonnie, let's say, it makes a ton of sense, right? Because most of these malls were built originally in a place where there was high traffic, right? Where there was, within X mile radius, there's, a certain number of people to drive business to the mall. So they're pretty well located assets, right? But what's the process? I mean, you have to be a pretty skilled developer and also have, the right connections in order to go through that whole process of rezoning and everything else. I mean, it's going to be a little bit of a tough deal for your average real estate investor, no?
Yeah, so I think, that's where these larger funds come into play. So they maybe have the capital and the bandwidth to take something down at a discount, still leverage the operating component of the asset. So if there's some of the tenants still in place, if there's a movie theater, if there's something that they can salvage in the near term, they let those continue to operate while they strategically get the entitlements and go through the zoning process on some of the other, potential pad site redevelopment opportunities. And so, historically, if you had a large mall site, the overarching land value underneath the mall may be $10 to $12 a square foot. But if you look at the smaller pad sites, the fast food restaurants and the other things, those maybe are worth $40 to $60 a square foot on the dirt. So it doesn't take a whole lot if you have some cash flow coming in to sustain some operations while you're doing the entitlement and some of the other development related, cost and hold on that.
Right. I mean, it just sounds like an absolute nightmare to me, dealing with town councils and city councils and zoning boards and everything else. So you got to get paid well to do that.
I was explaining to my kids recently what a drive-in movie theater kind of was back in the day. Basically, it was a placeholder for something bigger and better, right? Somebody would put up on land a movie theater that they could easily tear down when somebody else was ready to come in and build a mall. And when they were, the drive-ins started to fade away, and now you don't see that many anymore. And now people are starting to use malls as drive-ins, as we've spoken about before. It would be ironic if we started to see some of these raised and repurposed as nothing more than a drive-in movie theater while people were getting the permitting back and everything else they needed to really reposition this once again.
Full circle.
Yes, all the way back to that passionate necking that we talked about the last time we talked
Always
about.
Comes back to that with you. What is that?
It's a Wonderful Life.
Yes. All right. Looking at two sectors that have so far fared better than retail and lodging. First, multifamily. The National Multifamily Housing Council had put out a report that said 90.1% of apartment households made full or partial payment by September 20th. That's a reduction of about 200,000 from year over year. So those are households that are not paying their rent. But one area of the rental market that has seen growth is single family rentals. So what's that mean?
It means that us dang millennials want a backyard, but we don't have enough money to buy a house. Right? I mean, that's like the stupidly simple explanation, but single family rentals really sprung out of the last recession, right? When Blackstone and Colony Home, or what is it? I think it was Colony, and there was one other one that Corvest and some others came out and bought up thousands of foreclosed homes, kind of fixed them up and started renting them out. And they were renting them out, waiting to sell them, basically to flip them back when the market recovered. And then they realized this is pretty good business, renting them out. So I think now it's, that whole market has been growing since pre-COVID. And I would just say that now it's like when someone's, in a rush to get out of the city, they might rent a house for 6 months or a year while they look for the house that they want to buy, right? So the people with money may do that, and the people who don't have that much money, or they don't have enough for a down payment, much more open probably to renting a house where they have a little bit of a lawn, a driveway, potentially a garage, as opposed to their, 600 square foot studio with the bathroom, where the bathroom's in the kitchen.
Right. Their parents have run out of patience. Said it's time to
Move out.
to push you out. I was thinking about our session from a few weeks ago, the worst songs of all time, for which Keegan threw out Who Let the Dogs Out. And I was thinking about it today when I was looking through my pile of wires, and I was humming in my head, who took my dongle out? I wanted to go for a run. I wanted to plug it into my iPhone. All I had was the old school, plug,
Right.
and somebody walked off with my dongle, and I was thinking that would be a great song for Weird Al. Who took the dongle out?
I hope he's not listening. I hope Weird Al is not a listener.
That was the first like real uncontrollable laugh from me out of this podcast.
Live.
So
Live.
kudos to you, Manus.
Live. All right, let's turn to office before he gets on another one. Office has been a property sector that has held up for the most part during the pandemic, but there is a lot of uncertainty, and we've seen a number of reports and accounts that show that this is a mixed bag with some long-term uncertainty.
So let me get there, but I had one thing I wanted to ask Lonnie on multifamily before we move on, before Manus started talking about dongles. This is not an original idea, or maybe it is, I don't know, but to me, it seems like if you're a B/B plus multifamily owner, you're probably feeling pretty good right now relative to, other asset classes. But if you're a C owner or a A+ owner in central business districts, you got to be feeling some potential pain. Like on the C side, you're probably having trouble collecting rent, and you're probably not allowed to evict people because you've taken advantage of some Fannie or Freddie forbearance. And on the A+ side, you probably just have 15 or 20% vacancy because all the 20 somethings that were going to move into the city and start their, investment banker jobs or whatever it may be are not moving into the city. And a lot of your people are moving back to their parents' house or moving, out to those single family rentals. Am I crazy to that barbell concept?
No, I think you're right on. I think it goes back to the whole, speaking of cliches, like the workforce housing. So like if you're in the workforce housing sweet spot, which is probably that class B market, I think you're feeling really good because the folks that you cater to have probably been working the entire time through this entire pandemic, and they're still paying their rent. Whereas maybe the folks on the class C side are struggling to come up with the rent payments. And then on the A+, over the last 5 or 6 years in most major markets, seen an influx of new class A or A+ type luxury accommodations. And so from an underwriting perspective, from a development perspective, you kind of had to push to get there. You had to push rents to make it work because of the cost, the barriers to entry. So I think those folks are probably, struggling some, or at least teetering. If this lasts too much longer, they're definitely going to be the ones to fall, which will be a very interesting discussion at that point. How far do those prices fall? Do they come into that B type price range? And does that spur some new opportunity for folks to come in, reset the basis at a lower price point, and make those attractive from a rental perspective going forward?
So, if you were an opportunistic investor and you were looking for these types of potential opportunities, to be redundant, how would you even define for yourself, like how would you find the class C or the class A? Like what would be your, obviously in some places, a broker will tell you this is a class A or this is a class C or whatever. But like if you didn't have that, what else would you be looking at?
Yeah, so it's pretty interesting. If we had this conversation, 7 or 8 months ago before the pandemic, you guys probably remember at every conference or on every panel, someone would say, well, what inning are you in? And
Right.
It finally got to be we're like in the second inning of a doubleheader.
Right. Right.
And the reality is now, with COVID and the downward pressure that's come with that, it's hard because everything had been a value add essentially for the last 5 or 6 years. So you had a bunch of transitions within the market space. So you had B or C properties that had been moved up a class because someone had bought them, renovated them, put new countertops and cabinets in, and pushed the rents. So I think right now it'd be really challenging. I mean, on the class A, generally, if you're looking to classify properties, you're going to look at what the rent potential is, what the in-place rents are. Year built and multifamily is a key driver for that as well as geographic location. But generally speaking, the newer properties have more amenities, Wi-Fi, some more concierge type services. So I think those kind of define the class A. But right now, I don't think people are probably willing to pay those premiums for those services.
Right. Right. Well, in terms of what inning we're in, I think we're in the parking lot, getting ripped off by that guy who sells peanuts out of the shopping cart. You know, the guy who actually has a fire going with coals in the shopping cart.
Oh yeah.
He's roasting the peanuts. I think
Burning 'em.
we're there and we don't have any money to buy the peanuts, even though we're starving.
I was going to say it was the not hot pretzel. He's got the coals. He throws the really stale pretzel on, and it looks like he's heating it, and he gives it to you with like a napkin because it'll be careful, it's hot. And you walk away 10 feet and you bite into it, and it's ice
and
cold.
You got a tooth issue at that point.
That's right.
So all right, so Martha, office. We want to get there. So
let's get there.
A couple of data points coming out of some of our friends at Cushman and Wakefield. They put out a piece, kind of a very deep, forward-looking forecast where they were saying global office vacancy will rise from around 11%, which was pre-crisis 2019 Q4, to nearly 16% in the middle of 2022. So they're really seeing this as a long, drawn-out, slow creep up in vacancy. They're saying, this is just kind of the highlights, so you guys should read the piece, but rents bottom out in Q1 2022 and begin coming back after that. And then as the economy and employment recover, the office sector begins absorbing space at that point, and vacancy begins to trend downward. I like this part, the potential reversal of a decades-long trend of densification, in which businesses have been absorbing less space per office using employee, which means I really think this is, I don't want to be offensive here, but I think this is a story that the industry is telling itself, which is that, there are fewer people are going to work in the office, but we're going to need more space per person. I don't necessarily believe that myself. That's just my opinion. I think you show me a CFO who's, lived relatively effectively through this pandemic, and I'll show you a CFO who's thinking about cutting space by 25%, no matter what. That's kind of a little cutthroat, but that's kind of how I feel.
There was a headline this week. I'll take it a little detour quickly, and then we'll go back to office. But this is a headline that will probably make office owners cry, and will probably lead to hotel owners, opening up a phone book and looking for some phone numbers. But Amazon bought the Residence Inn Arlington Pentagon City this week for $148.5 million. They bought it from Blackstone. It was part of a Blackstone portfolio that backs a $415 million loan with 27 properties. It's the biggest property in the portfolio. But the headline was that Amazon plans to raise the building and in its place put up HQ2 or more HQ2 space. So for those property owners in Arlington that were hoping for, that home run by getting Amazon to come in and either take some of their space or build to suit for them on some of their land, that's out the door. But I could see some of these hotel owners thinking, hey, Amazon, do I have a hotel for you? So we'll see. But kind of one of those things where you're hoping that Amazon is going to take up, 200,000 or 300,000 square feet of somebody that already exists, but they're going to put up a new building. So no net absorption there of existing inventory.
Yeah. The couple of other data points, the Wall Street Journal again came out with another piece talking about how offices are still half empty 6 months into the pandemic. That's kind of physically empty, not vacant. But the Wall Street Journal put together basically curated a bunch of quotes from the CEOs of large corporations, and I like that they kind of span the gamut. But I'll just go through a couple of them. So this is about kind of work from home and going back to the office and that type of stuff. And Reed Hastings, the CEO of Netflix, he's been very outspoken on this. He said, this is talking about working from home. I don't see any positives. Not being able to get together in person, particularly internationally, is a pure negative. Larry Fink from BlackRock said, I don't believe BlackRock will ever be 100% back in the office. I actually believe maybe 60 or 70%. And maybe that's a rotation of people, but I don't believe we'll ever have a full cadre of people in the office. A couple of other small people, Warren Buffett, who we have to quote, no matter what he says, we have to see what he says, right? The supply and demand for office space may change significantly. A lot of people have learned that they can work at home or that there's other methods of conducting their business than they might have thought from what they were doing a couple of years ago. When change happens in the world, you adjust to it. Pretty vanilla quote from that guy right there, but that's okay. JP Morgan, Jamie Dimon, I don't know the future better than anyone else. I think going back to work is a good thing. I think there are negatives to working from home. See, I think if he had his druthers, he would be much more vehement in his words, but he's being PC. We've seen productivity drop in certain jobs and alienation go up in certain things. So we want to get back to work in a safe way. And the last one I'll do here is Tim Cook, Apple. In all candor, it's not like being together physically. And so I can't wait for everybody to be able to come back into the office. I don't believe that we'll return to the way we were because we found that there are some things that actually work really well virtually. So, sorry. I know I'm going on and on, but one more. So Ronald Krajewski, who is the CEO of Stifel, it's a financial company. I like this one. I am concerned that we would somehow believe that we can basically take kids from college, put them in front of Zoom, and think that 3 years from now, they'll be every bit as productive as they would have been had they had personal interaction in the office. So I think that's the biggest thing. Like if you're established in a company and you know what you're doing, you can probably work from home relatively effectively. But if you're a new person, whether you're young or old, if you're new to the company, I think it's got to be tough to kind of, ingratiate yourself in the culture and figure out what's going on via Zoom.
We'll have to see how it plays out. But if you look at the UK where cases are surging, it seems that workers are asked to head back home in order to keep down infections.
Yeah, this is very disheartening, to be honest. I'm looking at the BBC's website, and this is from yesterday. Boris Johnson said the new measures would probably stay in place for the next 6 months. Pubs and bars are closing at 11 p.m. They will also be restricted to table service only. People should work from home wherever possible. Limit, and this is an interesting one, the limit on guests at weddings reduced from 30 to 15. So imagine making the cut for that 30 and then saying, you know what? Sorry, man, you didn't make the 15 cut. I love you, but you're out.
Or how about picking the 1 out of 8 that can't bring a date?
And there's a couple, there's basically the point is that they're going back. They were starting to open up again, and now they're going back to a lot of the very restrictive rules for pubs, restaurants, and work and masks and everything else like that. So it's kind of a little bit of a sad note.
Yeah, the one website I would point people to, this is not Europe, this is the US, which rather than racing to the computer or in the old days racing to the New York Post to read the box scores, I now open this every day and it's updated twice a day, which is the NBC News graphic of reported coronavirus deaths per day in the US, which is a morbid headline, but it is encouraging data, and that's the reason I bring it up every day, is that, we saw the big spike in April, huge downturn through June, rose back up through what looks to be about early July, mid-July. And then we've been trending downward ever so slightly every week for the last, looks to be about 7 or 8 weeks. So whenever I get that, weak in the knees that we're never going to get out of this, I bring up this and it gives me hope that slowly but surely things are improving. And they update it twice a day, once at about 10 a.m. and once about 7 o'clock at night. So it was especially helpful when there was no live sports.
So one of the things we've talked about repeatedly is occupancy numbers, and those numbers have been good for some of the property sectors we were just talking about since the start of COVID-19. However, there are 2 types of occupancy to consider, and today's educational segment is brought to us by Professor Hendry, who will cover that.
Thanks, Martha. So, yeah, it's important. Occupancy can be a little bit misleading because generally what gets reported is the physical occupancy. So physical occupancy is pretty straightforward. You have 1,000 square foot space. Do you have a tenant that's actually physically occupying the space? And so you extrapolate that out over the number of square footage, the amount of square footage or the number of units in your property. And so that's a pretty good indicator of the health of the underlying asset. But in the pandemic or in times of economic disruption, there's the other form of occupancy that starts to come into question, and that's the economic occupancy, which is essentially, is everyone that has a lease with you and physically occupying the space actually paying the rent? Or are you as a landlord, when you're having renewals come up, having to offer free rent periods or other types of concessions? And so, it'll be very interesting to see as this continues, those physical occupancy numbers may remain in the 90% range, but they may only be collecting 78% of the true market, rental revenue. And so, where that comes into play is if I'm an appraiser in the marketplace and I see a property transact at a set price, and I see that there's some anecdotal footnotes to say the property was 95% occupied at the time of sale, I may use that in one of my reports as a valid, stabilized occupancy sale. But if they're only collecting 75% of the rent, I would need to make an adjustment for that because the building wasn't really 95% occupied based on the economics. And so it's something that I think that we need to monitor going forward, is just what does the real performance look like beyond just the physical occupancy.
So I saw some tweets this week, some from Donut Shorts, some from some others who, zero hedge, some others who like to be somewhat negative on the world. And one of them was a series of screenshots of multifamily or apartment listings and apartment advertisements from Portland and other kind of areas that are struggling right now, and with massive concessions, right? So sign up now, 12-month, pay for 12 months, get 15 months, right? Sign up now, get, a toaster and Wi-Fi and whatever the heck else it is. So, that's really all because you have, 100 people in your 100 units. It doesn't mean that you're 100% occupied, right? So if you've offered them free rent or whatever the heck else concessions you've done, and that, I think that's just the more concessions you see, that means the softer the market is.
Yeah. So for every month on a 12-month lease that the tenant gets free or doesn't pay, it's an 8.3% reduction in the economic occupancy. So those things add up, especially if you take them out across the entire property set.
So we did a few of the shout outs early, but we've got a few more. And I know of a couple. Manus, do you have any more?
We do. We already mentioned Matt Kelly and the notorious RD. Another shout out goes to RS, who was asking about what the real delinquency rate is. We've been publishing a 9% delinquency rate, but we've noted that if you included loans for which there have been forbearances and the borrower is not paying, that they're using reserves to keep the loan current, what would the number be? We had been estimating that it's probably another 2 or 3 points higher. We looked at this a little bit closer, and it seems like it's probably closer to 3.5%, 4.5% at this point, just based on the sheer number of forbearances we've seen over the last few months. We're going to put out a new study on that towards the end of September, and we'll report on that on our next podcast. But thank you, RS, for listening, and thank you for your question. LC of Chicago also just chimed in that they like to listen, and we're honored by them taking the time to chime in and give us some props for that. So thank you, LC in Chicago.
Yeah, and the Yankee Clipper Joe D from Brooklyn, as always, texted us after the podcast, giving us some good feedback, and he actually sent an article. I think it was from Indiana, because I think that's where we know some people in college there, and talking about a hotel there that is offering short-term rentals, quarantine, beds and other things to students and teachers. So that's kind of what we were talking about last week. The others would be Will S. from Vermont, who I owe an email to. And then Adam P. in Manhattan, my Cecil brother-in-arms, and also the little Broseph Henry. Thank you for listening. I'm sure we'll be talking again soon.
And Nori G from California and Jackie D from Dallas both actually were inquiries on the loan modification comments that we made a couple of weeks ago, and we're asking for templates. So we sent those along. And cue the deal of the week music.
Deal of the week.
We have two this week. The first one I love. Just a great sign of things getting a little bit back to normal on so many levels. TSCG negotiated a 33,000 square foot lease in Savannah, Georgia. It was reported by RE Business Online's Alex Tostado. He wrote about a lease going to Planet Fitness. So just when you thought that the gym space was dead, we have a 33,000 square foot lease.
Is this for the gym, or is this like an office for their headquarters or something?
No, this is a gym. It's replacing a shuttered Bilo grocery in Savannah, Georgia at the Crossroads Shopping Center. Michael Silverman repped Sunshine Fitness, who is a big Planet Fitness franchisee. Kelly Puglianano, I hope I pronounced that correctly, of TSCG repped the landlord. I keep mispronouncing that. Repped the landlord. Congratulations to them. The other deal of the week, Cobalt Property sold a 72,000 square foot office in downtown Charleston, South Carolina to Highland Ventures. This was reported by commercial property executives Jackson Chen. The property is at 134 Meeting Street and is 93% occupied. The sales price was $23.8 million, which was about $4 million higher than when the property last sold in 2014. Cushman's Jared Laundrie, Rob Cochran, and Nolan Ashton repped Cobalt on the sale. So congratulations to them for they're getting deals done in a time where it's not easy to get deals done, particularly in the retail space.
Let's quickly turn to CLOs, man, as we saw more bankruptcy news.
We saw Sizzler go down this week. You know, we've talked about before the casual dining space being hard hit, the combination of people not being able to sit down, casual dining facilities not being able to handle drive-through traffic, being reliant on that pickup. It's very been hard hit, that industry in total. Sizzler doesn't have a presence in the CLO space, but there are plenty of other casual dining operators that do. We've seen their prices of their debts really plummet over the last couple of years. Sizzler still has about 270 stores, locations across the U.S. Next week, we're going to be putting out a follow-up to some of our earlier CLO pieces that talks about the health of the casual dining market. So look for that over the next few days.
I think we should do an analysis of all eateries that rely heavily on the salad bar.
They're toast.
Because those are, no pun intended, they are toast. They're croutons.
There's a couple of things. You got the salad bar, you got the shrimp bar.
You got the soup ladle, right?
If you remember the old Ground Round, I don't know if they still exist.
That place was, that floor was always covered with peanuts.
Peanuts.
That's all I remember.
Free popcorn. Yeah. They don't do peanuts anymore in the Five Guys, so you can't put your hand in there and nosh on some peanuts before you get your burger to go. But this is a little bit morbid. I'll take it there for a moment.
Here we go.
But my dad is Mr. Red Lobster. Every Friday, he loved the Red Lobster. He would go there, the all-you-can-eat shrimp bar, and that's been off limits since March. And the morbid side of this was that his children would often say that when you go, we're going to spread your ashes at the Red Lobster all-you-can-eat shrimp bar. Right? There's no place that you are happier at than the Red Lobster all-you-can-eat shrimp bar.
Now it's gone. So on a different note, remember the ad campaign, what would you do for a Klondike bar? Of course you do. Well, we've got a riff on that. What would you do now that you probably would not have done pre-pandemic?
Well, this is not quite something I wouldn't have done pre-pandemic, but it's something that I haven't done much of since March. I already talked about shaving on consecutive days and wearing a blazer for the first time since March. I got a haircut this week in South Carolina, and I was looking up places that I could get a haircut before our presentations this week. So I went on a website where they offered $8 haircuts, and the listing on the website said normal man's haircut $8. When I went in there, it was $12 now. So they hadn't updated their website in a while.
Or you're not a normal man.
Well, that's possible. But my wife and I were looking at it, and we were scratching our heads, and we were trying to wonder, does it mean you must be a normal man to go in? To which my wife scoffed that you can't get your haircut there. Or is it a normal haircut, right? They didn't want to do things like those spiky things that the punk rockers did in Britain during the 70s, right? With the thing sticking straight up, no mohawks,
no mullets.
Anyway, I went in there, and for $12, I got a great haircut. You guys know they could take a village to make me look even just mildly presentable, but Ann did a great job. She would get $100 in New York for this haircut, I got to say. So that was my unusual visit of the week, and really happy Ann did such a great job on my hair.
Well, I would say wearing flip-flops to work and driving 11 hours to go on vacation, which is what I did last week.
Yeah, that's a good one. Lonnie?
Yeah, so I'm similar to Joe. Like, I don't know if I've worn socks all day since the pandemic started. So I'd probably have to go back to putting some socks on to go into the office. And for me, it doesn't change much. I'm kind of a workaholic. So pre-pandemic, post-pandemic, I'd probably just be doing the same thing. So this hasn't affected me too terribly much.
The only difference is now you might have some hair on that portion of your leg. When you lose all the hair where your sock is. Now it might actually be growing back.
Yeah, true.
You don't see that line that cuts off the circulation that the business socks create.
This is a dude problem, Martha. This is a white collar dude problem.
I'm glad I don't have to worry about it. With that, we'll close. Thanks to our producer, Keegan St. Ange. Join us next week as we look at what's happened during the week and how it has impacted you. If you have a question or a comment, send us an email at podcast@trepp.com. For more info, visit trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening, and stay well.
All right.